What is a bull market? A buyer market is the state of a monetary market where costs are rising or are supposed to rise. The expression buyer market is most frequently used to allude to the securities exchange, however can be applied to whatever is exchanged, like securities, land, monetary standards, and products. Since costs of protections rise and fall basically constantly during exchanging, the expression buyer market is ordinarily held for expanded periods in which a huge part of safety costs are rising. Buyer markets will generally keep going for a really long time or even years. Understanding bull markets. Positively trending markets are described by idealism, financial backer certainty, and assumptions that solid outcomes ought to go on for a drawn-out time frame. It is hard to anticipate reliably when the patterns in the market could change. A piece of the trouble is that mental impacts and hypothesis may some of the time assume a huge part in the business sectors. There is no particular and widespread measurement used to distinguish a positively trending market. In any case, maybe the most well-known meaning of a buyer market is what is going on in which stock costs ascend by 20%, as a rule after a drop of 20% and before a second 20% downfall. Since positively trending markets are hard to anticipate, investigators can ordinarily just perceive this peculiarity after it has worked out. A remarkable buyer market in late history was the period somewhere in the range of 2003 and 2007. During this time, the S&P 500 expanded overwhelmingly after a past downfall. As the 2008 monetary emergency produced results, significant decays happened again after the positively trending market run. Qualities of a bull market buyer advertises by and large occur when the economy is fortifying or when it is solid. They will quite often occur in accordance with solid total national output, GDP, and a drop in joblessness, and will frequently match with an ascent in corporate benefits. Financial backer certainty will more often than not move all through a buyer market period. The general interest for stocks will be positive, alongside the general tone of the market. Furthermore, there will be a general expansion in how much IPO movement during buyer markets. Prominently, a portion of the elements above are more effectively quantifiable than others. While corporate benefits and joblessness are quantifiable, it very well may be more hard to check the general tone of market analysis. For example, market interest for protections will teeter-totter, supply will be powerless while request will major areas of strength for B. Financial backers will be anxious to purchase protections, while few will actually want to sell. In a positively trending market, financial backers are more ready to participate in the securities exchange, to acquire benefits. Bull versus bear markets. Something contrary to a buyer market is a bear market, which is portrayed by falling costs and ordinarily covered in cynicism. The familiar way of thinking about the beginning of these terms recommends that the utilization of bull and bear to portray markets comes from the manner in which the creatures assault their rivals. A bull pushes its horns up high, while a bear swipes its paws descending. These activities are similitudes for the development of a market. In the event that the pattern is up, it's a positively trending market. In the event that the pattern is down, it's a bear market. Bull and bear advertises frequently match with a monetary cycle, which comprises of 4 stages: development, pinnacle, constriction, and box. The beginning of a buyer market is in many cases a proactive factor of financial development. Since public feeling about future financial circumstances drives stock costs, the market every now and again rises even before more extensive monetary measures, like GDP development, start to tick up. Similarly, bear advertises typically set in before financial constriction grabs hold. A glance back at a regular U.S. downturn uncovers a falling securities exchange a while in front of GDP decline. Step-by-step instructions to take advantage of a bull market. Financial backers who need to profit from a positively trending business sector ought to purchase right off the bat to exploit rising costs and sell them when they've arrived at their pinnacle. Despite the fact that it is difficult to decide when the base and pinnacle will happen, most misfortunes will be negligible and are generally brief. Beneath, we'll investigate a few noticeable techniques financial backers use during positively trending market periods. In any case, since it is challenging to evaluate the condition of the market as it exists presently, these systems include some level of hazard to at any rate Purchase and hold. Perhaps of the most fundamental technique in financial planning is the most common way of purchasing a specific security and clutching it, possibly to sell it sometime in the not too distant future. This methodology essentially includes certainty with respect to the financial backer. Why clutch a security except if you anticipate that its cost should rise? Hence, the good faith that shows up with positively trending markets assists with powering the purchase and hold approach. Expanded buy and hold. Expanded purchase and hold is a variety of the clearer purchase and hold technique, and it implies extra gamble. The reason behind the expanded purchase and hold approach is that a financial backer will keep on adding to their possessions in a specific security inasmuch as it keeps on expanding in cost. One normal strategy for expanding property recommends that a financial backer will purchase an extra fixed amount of offers for each expansion in the stock cost of a preset sum. Retracement additions. A retracement is a concise period wherein the general pattern in a security's cost is switched. In any event, during a positively trending market, it's improbable that stock costs will just rise. Rather, there are probably going to be more limited time frames in which little plunges happen too, even as the general pattern go on vertical. A few financial backers watch for retracements inside a positively trending business sector and move to purchase during these periods. That's what the reasoning behind this technique is. Assuming that the buyer market proceeds, the cost of the security being referred to will rapidly move back up, retroactively giving the financial backer a limited price tag. Going all out trading may be the most forceful approach to endeavoring to gain by a buyer market is the cycle known as going all out exchanging. Financial backers using this methodology will take extremely dynamic jobs, utilizing short offering and different strategies to endeavor to press out greatest increases as movements happen inside the setting of a bigger buyer market. Buyer market example. The most productive buyer market in present-day American history began toward the conclusion of the stagflation age in 1982 and closed during the dot-com bust in 2000. During this common buyer market, a term that indicates a positively trending market enduring numerous years, the Dow Jones Industrial Average, found the middle value of 15% yearly returns. The Nasdaq, a tech-weighted trade, expanded its worth more than 3x somewhere in the range of 1995 and 2000, ascending from 755 to north of 2,400. An extended bear market followed the 1982 to 2000 positively trending market. From 2000 to 2009, the market attempted to lay out balance and conveyed normal yearly returns of 1.16%. Nonetheless, 2009 saw the beginning of an over 10-year positively trending market run. Examiners accept that the keep-going positively trending market began on March 9, 2009, and was for the most part driven by a rise in innovation stocks. Why is it called a bull market when prices go up? The real beginning of the expression bull is liable to discuss. The expressions bear, for down business sectors, and bull, for up business sectors, are figured by some to get from the manner by which every creature goes after its adversaries. That is, a bull will push its horns very high, while a bear will swipe down. These activities were then related figuratively to the development of a market. In the event that the pattern was up, it was viewed as a buyer market. On the off chance that the pattern was down, it was a bear market. Others highlight Shakespeare's plays, which make reference to fights including bulls and bears. In Macbeth, the doomed protagonist says his foes have fastened him to a stake, yet bear-like, I should battle the course. In a fundamentally nonsensical uproar, the bull is a savage yet respectable monster. A few different clarifications likewise exist. Could it be said that we are in a bull market now? Conventionally, a buyer market exists on the off chance that the market has transcended its close-term lows. Since the emotional market auction during the 2008-09 monetary emergency, the Securities Exchange has shown a versatile buyer market, rising essentially, and arriving at new all-time highs over a decade after that market slump, regardless of a few sharp pullbacks en route. What makes stock prices rise in a bull market? Buyer showcases frequently exist one next to the other: a solid, strong, and developing economy. Stock costs are educated by future assumptions about benefits and the capacity of firms to produce incomes. A solid creation economy, high work, and rising GDP all recommend benefits will proceed to develop, and this is reflected in rising stock costs. Low loan costs and low corporate duty rates additionally are positive for corporate productivity. For what reason do bull markets sometimes falter and become bear markets? At the point when the economy gets into a tough situation, for example even with downturn or spike in joblessness, it becomes hard to support rising stock costs. Besides, downturns are much of the time joined by a negative turn in financial backer and purchaser opinion, where market brain science turns out to be more worried about dread or diminishing gamble than veracity or chance taking.